Hello traders, what is going on? So finally, Federal Reserve had increased their interest rate. And of course, there are a lot of analysis, a lot of projection, a lot of prediction here and there, right? So for us, we have our own opinion, we have our own analysis, and let's share with you what are the facts, what are the data, and of course, we will also share our opinion and how are we positioning our trading after this decision and how we actually position our trade even before this federal rate decision come out. So let's not dilly-dally and jump straight into it. So federal rate decision finally went up. The chart on the trading view have not been updated yet. It should be somewhere around like 0.5 like that. But for those who have been trading for a very, very long time, for those who have been around since 2015, right? Congratulations. Here we go again. We are going for another round of quantitative tightening, as you can call it. We have another round of tight fiscal policy and all these rates going up. So here we go again. And if you have been around since then, you have survived until now, right? I think this is something that worth having a badge lah. For example, on Tiger Broker, you should have a badge that say, hey, I have survived 2 rounds of interest rate increment. So that's I mean just saying lah. Okay, so let's jump right into the S&P 500 lah. So right after the news came out, right, the market kind of take the whole thing very positively. The market went up quite substantially. We have 3 green days in a row. So from the bottom, right, from the bottom here, we do have close to about 6% increase in our S&P 500. Of course, I believe the Nasdaq is even higher. Most of the recovery were led by the technology sector. But even then, right, if you compare to the last 1 month, February and March volatility, right, 6% increment over 3 days is really, I would say, nothing short of special lah. It's a normal movement lah. In fact, in February and March, we have seen much more violent movement without any kind of catalyst itself. But here's the tricky thing, because if you truly listen to the Federal Reserve, the FOMC meeting minutes, right? If you truly listen to it and pick out all the data and all the certain important points, things are not really bullish at all. In fact, I will be leaning more towards the bearish side or the hawkish side lah. Okay, so it's not that I'm the only one who feel this. In fact, a lot of the so-called the Bloomberg analysts lah, this analyst, that analyst, or all the analysts, they do feel similar. So it can be something like okay, if everyone is bearish, then it should be bullish lah, because like market do the unexpected, that kind of thing. But I do have a reason for why the market treat this as a bullish news and the market actually went up. Okay, so first thing first, if you look back in early January 2022 and towards February, right, a lot of things were really very uncertain. In fact, the inflation number haven't come out, the CPI number have not come out yet. Most of the banks' expectation, most of the institutional expectation of how much the rates is going to increase over the year, right, is also very uncertain. At one point, the consensus were the Fed is going to raise 3 times, then after that it became 5 times, and then now it is like 7 times. So this consensus changes after the January CPI came out, and then after February CPI, the consumer price index number came out. All these numbers changed here and there lah. So during February and January and February 2022, right, the key thing that is happening was everyone is in the dark. Nobody is know what to expect. Everyone is making like very extreme consensus or expectation, or rather everyone is preparing for the worst. Even the market itself is preparing for the worst. And of course, unfortunately, towards the end of February, we have the Russian-Ukraine war coming in, which kind of make things even worse. Oil price start to go up, and which caused the whole inflation thing to become even worse. Like you have gas prices going up, you have commodity prices going up. And if you talk about things like oil price and gas price going up, right? It is not just the petroleum price or your electricity will go up. Almost everything will go up. If you think about it, right? All the products you have in your supermarket or all the products that are in whatever retail store that is being stored there, how do you think all these products get into the retail store? How do you think all your vegetable meat get into the supermarket? They are being transported. They are being transported by trucks. They are being transported by, other vehicles. And this transportation cost is definitely going to increase because of the increase in gas prices, the increase in crude oil prices, and most likely that increase in transportation price, right? It is going to be passed on to you as consumer. That is why we have a lot of so-called food inflation going up. And this food inflation is not only driven by the soft commodity price going up, but also due to all the transportation cost that is going up. Okay, so because of the whole Russian-Ukraine conflict coming in, right, it makes the whole situation even worse. Things are already very unpredictable, and now due to the war, things are even more unpredictable. Hence, we have the market selling off in order to sort of price in the worst situation. But fast forward to current week, this week, where we have the FOMC meetings, right? The Federal Reserve actually kind of like share their plan. They were, I would say, very open about it. They are saying they're going to raise the rates, like I think about 5 or 7 times. I kind of forget the news, but they did mention the target that they are going to reach, and they also mentioned that they are not going to hesitate cutting growth in order to curb inflation. And this is one of the bearish statement. This is one of the statements that I truly felt quite bearish, because they upfront say, okay, we are not going to care about growth really. If we have to curb inflation at the risk of halting some of the growth, right, they are going to do it. So that was one thing that they say. So after the Federal Reserve sort of shared their plan and shared their stance on however the market, how they are going to deal with inflation, right? The market rallies, and we have extended rally for 3 days. So this is what you see on your S&P right now, where the market kind of like close to breaking the 44,000. S&P 500 is close to breaking 44,000. So what actually changed? In fact, if you look at in terms of all the macroeconomic factors at the background, right, nothing really changed. Things are actually is as bad, but there's one thing that changed is now there is predictability. Or the market is no longer working under mystery, or it's no longer working under a lot of I would say trial and error. Now we have like upfront number, we have upfront projection that the market can actually works with, and market likes certainty. And when there is like things that numbers and projection that you can work with, right, the market kind of like calm down a bit, and it rallies off lah. So what we can also assume is that perhaps in the past 2 weeks, right, the market kind of I would say prepare for the worst, but after we have all these new projection, right, things is not as bad as it seems. That's what the market thinks. So but however that's the, I would say, so-called the only good news from the FOMC meeting minute. But on the other hand, we have also some other good news that are coming in, and that is the peace, so-called the peace negotiation with Russia and Ukraine. It seems to be slightly more concrete now. Russia wants Ukraine to indefinitely stay out of NATO, and in return, right, they want to discuss peace. So even on the Russia-Ukraine conflict side, right, things seems to be a little more predictable than what it is used to be back when it was 2 to 3 weeks ago. So a lot of certainties are returning into the market, and market truly likes that. And of course, on the eastern side, we also have China making a statement saying that they are going to support the stock market. They are going to hunt down all the short seller, this and that. So we have one of the biggest rally in the Hong Kong market. I truly hope maybe some of you who are invested in Hong Kong, right? I do hope that you manage to enjoy this relief rally and hopefully this will sort of create a bottom in the future with regards to Hong Kong market, right? I believe that a capitulation have occurred, but of course going forward, similar to the US stock market, right? I do not really foresee a V-shaped return also. I think the market itself needs some time to digest. Most of the rally, I believe, is caused by short covering rather than actual buying. So maybe for Hong Kong, price will kind of like sideways a bit before it creates another run. So Hong Kong, we will keep a close lookout. For us, we don't really believe in buying the bottom in order to catch this, but we want more sort of like a sustained uptrend. We do not want to buy a sudden up move and then after that it goes all the way down. So we want to see at least some higher low coming in before we buy into this sustained uptrend. Okay, so that is just to sidetrack into the Hong Kong market for a while. So with that said, right, things seems to be pretty bullish as we recover 6% from the bottom, but that's where most of the good news end, because as I mentioned, right, at the background, a lot of the macroeconomic data are not really very positive at all. And upon the news coming out, right, the 10-year yield, the 7-year yield, the 5-year yield on the treasury yields, right, the treasury bonds, they actually shot up to quite an unhealthy level. And when we are talking about yields, right, the higher the yield, the higher your so-called the higher price corporate have to pay to get loans or get to sell their bonds, the higher interest they have to pay. And higher yields meaning is a very big negative impact on growth counters. And now that they are going up, right, it's gonna impact their growth even more. It's gonna impact most of the growth company out there. And let's take a look at a few things. Okay, so currently S&P is at resistance about 4400. So before I want to be like more towards the bullish side, I would want to see some support at 4400 before I buy in. So currently the S&P is testing the 4400 as a resistance. So it is not retesting at a support. So maybe what we can foresee is we might have another short rally and then it will retrace and retest the 4400 as a support and then it continue to rally. Only then I will buy in the rally. But another possibility is that 4400 going to get resisted and it's gonna go down some more. So if you look back in February, late Jan and early Feb, right? This level 440 was actually a very, very strong support. And market kind of like did a relief rally about also 6-7% like that from the bottom. But at the current stage, this level here is now being tested as a resistance once already. So now it is going to test it the second time. And it is very important. And in fact, today, right, I believe is the quadruple witching day, and it is a very I would say going to be quite a volatile day. I believe due to the quadruple witching day and a lot of volumes are going to come back in. There'll be a lot of portfolio rebalancing going on. So hopefully if you are a bull, hopefully price manage to close above 440, or if you are a bear, then 440 will become the resistance and you can start looking out for short positions. So we will share what our positions are, but let's go through a few things. Okay, so FOMC projection. So we talk about a lot of negativity in terms of macroeconomic in the background. Okay, so first thing first, the Federal Reserve FOMC projection. So this projection are what FOMC sort of like a prediction on the GDP lah, unemployment lah, the federal fund rate lah. So you can see here the first line. This is the GDP projection for 2022, 2023, and 2024. So this number came out on the day of March 16 lah. So after they made the raise in the interest rate. Okay, so in 2022, right, we have a GDP of 2.8. And in 2023, 2.2. And in 2024, 2.0. So we are actually looking at decreasing in the GDP. This is a GDP contraction. So the Federal Reserve is actually forecasting a recession. It's actually forecasting a recession. So if you look at the December projection, right? December projection is referring to what they have projected in 2021 December. Okay, so in 2021 December, they make some projection. And back then, they made a projection of 4.0% for 2022, but now they change it to 2.8, and that is a very drastic decrease in GDP. So we are definitely going to see decline in GDP for 2022, and what you have to know is that GDP is a leading indicator. So if we are forecasting a decrease in GDP for the entire of 2022, right, most likely the stock market is going to fall somewhere within 2022. But the key thing about things like GDP projection, all this, right, it is these are macroeconomic projections, so they cannot be used to time the stock market. So you see this today, right? You cannot immediately go into your S&P 500 and start shorting left and right, because the economic data are not meant to time the market. You still need a lot of other factors coming in. But what it does give you is it sort of give you like a general tone of how the market is going to be like moving forward. So since we are talking about GDP, right, let's take a look at the conference board also. This article was released slightly earlier on the March 10, but most of the projection here are somewhat close to the FOMC projection now, okay? But the good thing about here is we get to look at the Q1, Q2 projection. So if you look at 2021, these data are real data, okay, the real GDP. So these data are already established data. They are not projection. They are real data that is being already reported. So if you look at 2021 Q4, the real GDP is 7.0. But as we go into 2022 Q1, right, it is 1.7. Okay, so if we compare that, if we compare quarter to quarter, right, that's a huge decrease in GDP. And if we compare back to 2021, right, it is also a big decrease. Q1 of 2021 is also a big decrease. So we actually have a contraction from Q4 2021 to Q1 2022. And not only that, in Q2 2022, we have 1.3, which is lower than the Q1 1.7. So we have 2 consecutive quarters of GDP contraction. So what we are actually looking at is like, you can kind of say the conference board or the FOMC themselves, right? They are actually forecasting a recession. So even here, 2022 projection, we have 3.0. Okay, so this 3.0 is for the entire year, which is lesser than 2021 5.7. And in 2023, we have 2.3, which is lesser than 2022 projection 3.0. So it is like lesser and lesser, and that is a economy contraction, that is a GDP contraction. Okay, so if we compare these 2022 and 2023 projection back to the FOMC projection, which is the more updated, right? It's even the FOMC projection is even lower, 2.8 and 2.2, where on the 10th of March by the conference board, we actually have a slightly higher projection. So things are not really going well. So now the first question that you might want to ask is, okay, so if everyone is expecting doom and gloom, since it seems like the projection already confirmed a recession coming in, right? Why is the market going up? Why is the market rallying? So number one, the market, I would say, it's not really rallying. This is, I would say, just a relief rally. Is you can call it a dead cat bounce, which we have seen a similar dead cat bounce lah. So this kind of movement is nothing spectacular given how the price movement is like in the past 2 months. So there's nothing special. We are not seeing a very huge recovery like how we see back in here at the end of the COVID-19, where we actually have about 9% 9% movement in one day, or even here, right? We also have a 9% movement in one day. But what you notice is that even this 9% movement, right, it still continue to fall another 10%, 11%, which is a very substantial fall. So if you look at how the current price is right now, we have already fallen about 13% from the top. And to be truthful, if it falls off another 10% or maybe even 6-7%, right, it is a significant drop, and it is something that I would say not out of the ordinary. That can definitely happen. So what you see with the rally here is it is just the market rallying on certainty. It's just that the market realized that, okay, we have all these numbers ready, so there's a relief rally on the way lah. So that's the way I see it. And secondly, right, the market doesn't really price in so far ahead. So it's a little bit hard to accept. So if you already know recession coming in, why are you not selling? So I mean, if the recession coming in like somewhere around third quarter of 2022, or maybe even the fourth quarter of 2022, right? I don't think they are going to sell off immediately right now also. So I mean, this is my opinion, my sort of like what I feel. Whether is it true or not, I don't know. We don't know. No one knows. But there is a much more, I would say, concrete reason, and that is in Q1 of 2022, right? We have our earnings season, and actually, a lot of the earnings are very strong. If you look at Google's, Amazon, Apple, all the heavyweights of your Nasdaq and S&P, right? The earnings are very, very strong. The EPS is increasing, revenue increasing, and it beats all the estimates, the Wall Street estimates, and it didn't really just beat by a margin, it actually beat by a lot. So in terms of earnings, right, things are still very positive, and because of that, right, the stock market isn't going to sell off. But the thing is, the moment you start to see earnings start to drop, you see the revenue growth start to drop, right, that is when the stock market will start to sell off. So it is usually the earnings that leads the market to sell off lah. So if we are looking for any kind of recession movement for the stock market itself, where you expect the market to fall, right, we are going to be maybe looking at Q2 earnings or even Q3 earnings. So if Q1 earnings is very strong, right, then why will we expect Q2 or Q3 earnings start to fall? Because the effect of inflation, the effect of all the oil prices will only start to kick in sometime right now. So maybe in March, in April, in May, right, you will start to see that a lot of consumers, they are going to spend less. They are the house pricing in US is like all-time high right now. A lot of home builders are facing a lot of I would say supply chain issue and all these kind of things, right? And because of the inflation, food inflation, oil and gas inflation, right, consumers are going to spend less. They are going to buy less Tesla, they're going to buy less Nike shoes, they are going to spend lesser on all these luxury stuff, they're going to buy less iPhones. So not only that, because of the yield going up, right, the bond yield going up, the bond spread going up, right, what you will start to see is corporate companies, they find it very hard to get easy access to cheap money, and they are not able to expand so much. And because of all this, right, it will ultimately lead to their growth getting hurt, and ultimately it will affect their bottom line, their net income, net earnings, and that can easily lead to Q2 or Q3 earnings starting to show decline. And the moment that becomes very clear, right, that is where the stock market will start to sell off. So now until then, right, maybe the market can continue to rally, who knows, but I highly doubt that S&P can actually break the all-time high that we have at 4,800 level. So I doubt S&P can easily break this. I would say within this year, it's going to be very, very choppy going forward. It can go up, but it can easily come down also. So because of all these factors, right, please be careful. Please truly be careful. And I also want to talk about the yield curve also, is that upon yesterday announcement, right, the yield curve actually kind of like flattened. It flattens by quite a bit. So what you can see is that the 20-year yield is now higher than 30-year yields. That's why you see this line coming down. And you also see that the 7-year yield is higher than 10-year yield, so it's like flattened, and you can see all the lower end of the yield, right, they are starting to go up lah. So at some point when the yield curve flattens, right, it is a sign of recession. It is the early sign of recession. Every time the yield curve flatten or invert, what you will see is maybe in the next 6 months or 1 year, right, the economy will go into a recession. So if I push back the timeline to right somewhere before the COVID-19, right, you will start to see that this yield curve, it is kind of like flattened, like quite flat, or it is kind of like inverted. You can somewhat see it. So in a normal situation, right, your yield curve should look something like this. It should look something like this. It is like a going uptrend, like it's like a hill, it's like a slope. But the moment it start to plateau, right, it is a sign that we have incoming recession lah. So even back in 2008, 2009, the housing crisis, right, we can see at the top the yield curve actually flattened. And if we look at from 2004 to 2007, 2008, right, you can see how the curve actually slowly flattens to the point where after that it crashed. And the moment it crashed, you see the curve become normal again, and then it will start to go up, go up, go up, go up, go up. And then when it reached somewhere close to even here, right, even before the trade war 2018, you can see it flattens a bit before it went down here. It went down, and this little portion here that is like truly very flat. And of course, during the COVID-19 crash, it was kind of like, it's not as flat as what it used to be, but it is kind of like quite flat. There was already some economic distress happening. And back then, right, I would say that the economy is already in quite a bad state. Quite a bad state. The Federal Reserve actually got out of a jail card because COVID-19 came in. COVID-19 came in and kind of like bailed them out. It allowed them to like get out of jail free card, in a sense, like, hey, COVID is here, we need stimulus. So they managed to get out of the situation that they are in. And similarly right now, they also have like a get out jail free card due to the Russian-Ukraine war. At least they have something to point their finger to with all these inflation that is going on. So you might think that hey, how come it is always a coincidence? Whenever like the economy in distress, right? Something bad happens, something uncontrollable bad happens, and things start to turn very bad. But what you will notice is that the yield curve inverting and flattening, right? All these are actually caused by large investors who are selling bonds. So if these people are selling bonds, right, the yield go up, and so the yield curve is a man-made event. So sometimes you might get into all the conspiracy tinfoil hat moment where you will think maybe all these people who are selling off the bonds, they probably know something in advance. That's why they are selling off the bonds and the yield curve start inverting and flattening. So I mean, this one I truly don't know. I'm just pointing out some data and some events that follows the data. So most of the time, whenever the yield curve invert, right, we do see economy distress. But one thing you have to note is also, before any kind of economy distress, the rally is always the strongest. Even in a bear market, the biggest rally are often seen in bear market where you don't really see 9%, 10% return on a index chart, which what we just see in the Hang Seng Index. You don't see that on a normal bullish market. You only see that in a bear market. So once again, right, we don't really want to make a lot of doom and gloom play, but it is to ensure that you have a full perspective of what is going on before you start to YOLO everything and pick the bottom and throw your entire money inside the stock market. Because I believe a lot of us actually suffered drawdown or suffered a heavy loss during this period, and I truly do not want people suffering another heavy loss because they misread the situation. So whether you are a short-term trader, if you are a short-term trader, definitely you want to buy this rally. Of course, it's definitely a viable strategy, but make sure that you know what is going on and you know your trade plan. Don't blindly follow people buying, because maybe the guy that bought S&P might be a short-term trader, but you are an investor that's looking to hold long-term, you know, that kind of situation. Okay, so personally for us, right, if you have been following Nimbus Capital, what we are doing, right, most likely you will know that we have been in short position somewhere around mid-February, like that. As early February, right, we have shared our plan for the year. We have mentioned that this is the year where you truly want to have a portfolio with both long position and short position. You want to short the growth counter that are tapering in growth, that are no longer growing and cannot make profit. So we have actually made a lot of profit from Snowflake shorts, Rivian short position. These are all the positions that I shared with my subscriber, or after the trade was made, right? After we take our profit, I actually share publicly also. These are the position that we took. So currently, as of this moment, right, we have taken profit on majority of our short selling already, but we still have a few short position that we have ongoing, and those positions are actually Starbucks and the Children Place. Okay, so Starbucks, our shorts was actually at $92. Our short started out at $92. Then after that, when it hit our TP level at 80, right? It hit our TP level 80. Maybe some of our subscribers, they take their profit and ran, but personally for me, I didn't run. What I did was I simply shifted my stop loss to my entry price, which is at 82. That means to say that if the market U-turn on me and start to go back up, right, I'm gonna exit this trade with a break even. At least I do not lose any money. But of course, right now the market rallies up quite a bit. Starbucks actually rallies up quite a bit, but it is still quite a distance away from 92. So I'm still holding in with some unrealized profit. Hopefully it doesn't eat into my my break-even price, and then I did not get any profit. So hopefully this will create like the next high and it start to go back down, close the gap. Who knows? No one knows. But that is my trade plan, because you have to understand whether this is going to go down in the future or not. I do not know. But what I know is I have a plan and I'm willing to risk losing my unrealized profit for a more future profit. Give me 1 second. I need to sneeze. I'm so sorry. Okay, so my nose is not cooperating with me. So another short position that I'm still holding is the Children Place. So the Children Place is a retail store. Okay, so we held this position for quite some time already. The entry was back at $70. It was very, very early, $70. Now the price is at like $54. So even with the recent recovery, right, we are still in great profit. In fact, if I choose to run now, right, if I choose to run now with the current profit that I have, it is going to be close to 22% price movement. So that's a big profit. But given how the chart is not really responding to the past 3-day bullish price movement, right, I am holding on to this this particular short and see how far it goes. So not only that, I am also holding on to a few long position, and one of it is Alphabet. Okay, so sometimes, right, you may be bearish on the whole market itself, but you do not want to like go 100% short position, because if suddenly market like spike up or a market does is dead cat bounce or a relief rally, which can be like 5 to 6% in the index moving against your short position, right? You can get emotionally affected, and then you start liquidating your short position. So counters like Alphabet, I have Alphabet, and I also have Mastercard. These are the two long positions that I have. So these two positions are in my portfolio to kind of like as a insurance. So let's say I am wrong. Let's say I am wrong about everything. The market rally, the market breaks the S&P break all-time high within like May like that. Then these two positions are still going to sort of recover the money that I'm going to lose in my short position, and these trades are going to give me profit in the future like, as market recover. But what you will already notice is that I can exit Starbucks at break even. So meaning if the market suddenly recover, right, I'm not going to lose any money in Starbucks. I'm just going to forego some unrealized profit, but I can still exit the children place with a very good profit position. So meaning in situation when market recovers sharply, right, I'm not going to lose any money from my short position, but I'm going to get a lot of profit from my Alphabet and Mastercard. So this is the whole idea of having both long position and short position. But of course, in order to execute this kind of strategy properly, right, you need to ensure that you take your position properly. Like you are not randomly buying random long position and short position also lah. So that is my current portfolio right now. So regardless of where the market direction goes, right, I'm not really that worried. In fact, right now, my portfolio price movement, my overall portfolio volatility is very low. Yes, Starbucks gap up, my profit is gone. But at the same time, Google and Mastercard are also going up, which kind of like undo the loss from what I'm facing with Starbucks. And of course, let's say if the market decide to go down further, dive down further, right? What I'm going to do is I'm gonna add more short position. I'm gonna add more. I'm gonna stack my Starbucks short. I'm gonna add more position onto the children place. I'm gonna find more shorts. In fact, I have a very big watch list of potential short position that I'm ready to add. So all these profit from all the additional short position will give me all the profit, and eventually I will just cut Google and Mastercard at their stop loss. No doubt they are gonna take some losses from there, but the profit from my short position is going to make up more than what I have lost. So sometimes when the market is in this kind of unpredictable situation, right, you need to do this kind of strategy. You need to make sure you have a proper strategy in place, because you cannot always be a 100% long and 100% short given how the current market situation is. So hopefully this gives you some insight to what's going on and how to prepare and what to trade in the future. If you want to know what we are trading, what my portfolio is, and how I am managing my portfolio during this period, right, you can join our Patreon, and we share our portfolio live lah. So live in the sense that whenever I make any trades, right, I usually share, and of course you will get access to all these trades timely lah. And also, of course, I am quite proud to also share that my rate of return for the month of February is actually 18.5%. We actually, to be fair, beating NASDAQ in 2022 is nothing to be proud of, but considering how the market is going down left and right and everyone is crashing, everything is like not in a very good state, and also considering how hard it is to trade current market, right? I'm quite proud of my return for this month, and hopefully I'm able to reproduce this return on March and May, and hopefully we get a very good year for 2022 lah. Okay, so that will be all for this session. Thank you very much guys for tuning in, and have a nice day.